Dear class, today let us cover lease accounting. That will be lesson number 5. As we know that investment or purchase of capital asset require heavy amount of money. So the one way of avoiding heavy investment is to purchase a capital asset on a purchase system. Or the other way is to get the capital asset on lease, and they use it as per term of lease agreement. So leasing is defined as a method of acquiring right to use an equipment or an asset for a consideration, for a payment. So it involves a contract between the owner of an asset called the lessor, grant another party, lessee, the exclusive right to use the asset, usually for an agreed period of time, and then in return for the payment of rent. Normally we have two types of lease. One is a finance lease. This finance lease is known for its features or characteristics. So one of the characteristics of the finance lease is that the lessor transfers the title to the lessee at the end of the lease period. And again, the lessee has the option to buy the asset at the end of the lease period, or the lease buy the asset at the price agreed if decided to do so. Again, the lease cannot normally be cancelled, and the present value of minimum lease payment at the inception of the lease, it is almost exceed or substantially equal to the fair value of the leased asset. But number 2, we have operating lease. So these leases which have no conditions that are present in a finance lease. And such agreement gives a lessee the right to use the leased property for a limited period of time. But it doesn't include the transfer of benefit or risk that are associated with assets. Even lessor is responsible for maintenance of an asset, paying insurance, and any other related expenditure. So we have a difference between operating lease and the finance lease. One is the duration. Usually finance lease take an entire useful life of an asset, but in operating lease is a shorter duration. But it is not revocable, that you cannot cancel it, finance lease, but it is revocable in operating lease. Cost of maintenance in finance lease, the lessee bear all costs of maintenance, but operating lease, it is the cost of maintenance, repair, taxes, insurance are paid by lessor. This is risk. Lessee has to be at the risk of service, and in case of operating lease, it is the lessor that bear those risks. Fixation of lease rentals. Lease rentals are so fixed that they cover not only original investment, but also reasonable return on the investment. The lessee rental, on case of operating lease, lessee rentals are not generally sufficient to motorize the cost of the asset. Option to buy in a finance lease, there is an option that at the end of the contract, the lessor may buy an asset, but there is no such options in operating lease. So example, let's look at an example. For instance, we have ABC Limited, the lessee, acquire a machine on lease from leasing company, lessor, on January 1, 2009. The lease term covers the entire economic life of the machinery. That is 3 years. As per the term of the lease agreement, the machinery would revert, be returned to the lessor at the end of the lease term. So the fair value of the machine is given. Fair value of the machine is 235,500. So the lease agreement requires the lessee to pay an amount of 1,000 per year beginning December 31st, 2009. So the leasee has a guarantee to residual value. So at the end, the asset will remain with only 17,000 on December 2011 to the lessor. So lessor, however, estimate that the machine would have a salvage value of 3,500 in December on the same date. So here we have to calculate the interest rate. So the interest rate on these 3 here, we have a fair value which is equal to those return annual rent plus the residual values. But we discount this with the interest rate. So that interest rate is not known. So we have an annual rate is known that at each of the every year we'll be paying 100,000 for 3 years, and the residual amount with the same year. So if you make a calculation, it will be 16% mathematically. But again, we may use, we have alternative number 2, that the interest rate may be calculated by looking for annuity table, and sometimes we may use a trial and error. So in a presence case, the factor $235,500 divided by average cash flow per annum. So remember that average cash flow, the cash flow will amount to a 3 year, we will pay 100,000 for each year for 3 years, so it will be 3, and the salvage value is 17,000, so we'll end up paying 17,000 divided by 3, so yearly we will have 107,667. So the factor to be located is a 2.22. So this factor 2.22 will be located in the annuity table in a line representing number of years corresponding to estimated useful life of the asset. So if we take a table, for instance, this is annuity table, we have a period, year 1, 2, 3, but again we have a different rate on the top. So if you look at 2.22, where can it be located using after 3 years, you'll find that it will be on a rate 2.28 is 15%, but 2.22 is between 16 and 18. But 18 is a 2.1, but if you consider it is a 2 point, so approximately is a 16%, which is found in the year 3, 2.246. Again, 18 is found 2.1, which is more or less than 2.22. So again, we take this 16%. So again, let us look how the leasee will present this in his book, the book of leasee. So the leasee who get that machine will bring that machine into their books of account. So in such case, we debit lease the machine, and they will credit obligation under lease finance. So as a creditor, we credit lease the machine with 235,500. But again, after the end of the year 1, 31st December 2009, we will charge interest, which is 16%. So this interest will end up at 7,680. So in the same December, we will pay. So we debit obligation and a finance lease, and we credit bank with the 100,000. So the balance being taken to a second year, balance brought down, which is 173,180. So again, in a year 2, we'll charge interest for the balance remaining. And again, at the end of the year 2, we will pay credit bank and debit obligation and the finance lease 1,000, and then we charge interest. Sorry, the remain balance carry down. We charge a balance carry down. So this balance carry down, then we charge in a year 3. At the end of the year 3, we charge interest of 16,142, where we pay bank 100,000, and the interest charge is the balance, the residual balance that remain. Sorry, on the debit side there is a mistake. The 1,889 is the balance carry down. It's not interest. And on the year 3 also, that interest should be read a balance carry down of 17,031. So this amount is what will be shown as a residual amount of that asset, and the leased machines will be shown as a balance carry down, balance brought down. And at the end of the day, it might be charged also depreciations, because this is one of the assets in the business that are used to produce the cash in the business. So even a depreciation charge should be charged, because it's the one who used it to generate a cash flow. And at the lessor also, it will be shown as a liability. So the machine will be deducted, and that being shown as a receivables. So we will credit a machinery account and the debit receivables of 335,000. Again, we charge interest of 37,600, which is a 16%. So the balance we receive cash in the bank, and the balance we make it carry down. So we make balance carry down, and then we charge the interest of 16% on debit side, so it becomes 200,889. Then we collect debit bank account 1,000, and the other is not interest. It will become a balance carry down. And that balance brought down, we should charge also interest, and then we recover with the bank, and the other remaining residual, the machinery remaining residual of such amount. So that's how also will be shown in the books of lessor. But in operating lease, that is very common. Lessor should present an asset given an operating lease if it is balance sheet under fixed asset. So, and the leasee cannot brought some assets that are leased for a very short term in his book of account. So that marks the end of this presentation.